Hey everybody, Tom Gentile. Welcome to our week 2 of Optionetics. This is week 2. We're going to be getting into spreads. Got a lot of stuff I want to get into. Some of you probably don't know I am live from New Zealand right now in a very big open space inside our new home. So if there's a little bit of an echo, I apologize. But what a beautiful place we have here. I got a couple quick little photos I'll show you of where we are, but check that out. But more importantly, I want to talk about what we can do today to help out on some of the stuff we looked at last.
Okay, Tom, we lost you.
Last week. So last week, you remember we looked at calls. We looked at now.
Okay,
Jay?
You're back now. You're back now.
Hello.
You're back now.
Hey, sorry about that. So we got a lot to cover here. Just let me know, Jay, if you lose me, and then I'll kind of repeat what I said over the last few seconds.
Yes, sir.
Feel free to ask questions, guys, in the Q&A box. Also, this session is being recorded. I'll get the recording out to you shortly after the live event is over. Also, the disclaimer you see on your screen, you can read this from its entirety on the recording. Just hit pause. Couple of quick points I want to make. Stock and options trading has large potential rewards, but also large potential risk. And then, of course, myself, Jay, everyone associated with Tom's Trading Room and Optionetics, we're here as your educators. We're here to educate. We do not give specific trading advice, all right? We're not brokers. You need a broker to trade with. And everything I'm going to talk about tonight is in U.S. dollars, unless noted otherwise. Hey, happy Valentine's Day to all you guys. So really cool. I want to show you real quick as we get started. This is where I'm at right now. Jay, can you see that shot?
We do see it, yeah.
There's still been some construction. Actually, this is a little video. I'm going to just go ahead.
And you just dropped out again on your sound, Tom.
Okay, there you are. There's a little bit of construction.
And you disappeared again. The comments coming in are, wow, nice. But Tom, we lost your voice.
Yeah, we got some deck. Try to keep moving it along here. Here's another one.
Very cool. I'm sure you can see the comments there too, Tom. People are commenting on how beautiful it is.
That's on the other side on the cliff. Yeah, it's a great little space there. We're happy with it. So how about now, Jay? Am I back?
You're back. I think the streaming kind of cut in, but yeah, we're good.
Jay?
Yep, we can hear you.
I thought so too. Yeah, I'm gonna do very little, I think, with going forward with any activity because our internet access down here is on satellite, so it's not as fast as what I'm used to. That being said, I've got everything kind of canned up into the presentation, so we'll be able to get through the majority of what I want to show you guys. You know, our weekly webinars are from 8 to 9 p.m. We're doing this for the entire month of February. Like I said, recordings are going to be out soon. Slide handouts. Anything I have that I think is essential for you, I'm going to make available here. So last week we did a handout with our oil and energy pattern, and I'm going to spend a good bit on that, but I'll give you a small handout on our Darknet design, which is what we're going to be talking about tonight. So week 2 is where we are. We'll do a quick review. We're going to talk about spread trading. We're going to talk about trading the Darknet strategy. All right. Jay, am I coming in loud and clear?
You are still coming in loud and clear. Yes, sir.
I want to definitely talk about this. So last week, I also showed everybody my brother-in-law's account. So, I mentioned the fact that you don't need a lot of money to trade with this. So he opened an account. It was probably a little more than a month ago, and I showed you what he had done in the last month, and that's on the left-hand side. That was last week's snapshot. I said, give me a snapshot today. So at 2:56 p.m. Eastern today, he gave me this snapshot. And so he's shadowing me right now with a smaller account. As you can see, he had a big spike here, all right? Well, he's been taking on a little more risk than I think he should be as far as the percentage of this account. But he's still doing well. I think I told him, I said, hey, this is great, but you're taking on a little more risk than you should. He's like, yeah, I know. And I said, so part of the rules are we want to risk a little. And so if you have a little, you got to risk a lot smaller than, say, an account that would be a $10,000 or $25,000 account. but he's trading options in this account. He's doing the strategies that we teach right here. And I just want to kind of show you how he's moving along during the course of the month. So why do we trade options? We trade them because of control, right? We want to control a lot for a little. We also trade them for protection. You can protect the stock itself by using options. You can also use options in place of a stock, and therefore, if it drops really hard, you're not following along with that drop too. And of course, we're going to talk about paying for protection today, which is by offsetting options. Now, last week we talked about calls and puts. Remember, calls give you the right to buy, and puts give you the right to sell. All right. I don't want to spend too much time on this. If you missed last week, then check last Wednesday evening, and you should have gotten a recording from me of the entire event. Now, we also talked about this particular, this detail here, which is an XLE long 63 call. All right, I think if you take a look at that now, the oil markets have actually been responding very positively here in the last week. And so especially some of the stocks we talked about. All right, I'll get into those in a moment. But you can see here, what are the things I want to show you here? First of all, this is a longer term option. All right, so Jay was telling me one of the questions that had come in.
Yeah, I just unmuted myself in case you wanted it, Tom.
Yeah, just before we had started the webinar, we were offline for a sec, and he said, "Hey, one of the questions that came in has to be with one of the students is expecting a market correction real soon and wants to know how do we incorporate market corrections in the strategy." There's a couple of ways, but let's just talk about this one. So the short-term correction in the market, I think, plays very little to what we're doing longer term here. So if you think there's going to be a 1 week or even a 1 month correction, if you're buying an option that has 6 months or 5 months in this case to expiration, you really are kind of protected by time, number one. And number two, if you really think that there's something that's going to go on with the markets that's going to pull it back, then instead of the limit price, which might be on the higher side, maybe you dump that down to 280 or 275 or 250 and try to incorporate, if you think the market's going to pull back, say 5 or 10%, how would that play into where you think this particular stock or ETF would go? Part of that would mean you need to know how well this correlates to the overall market. And in our tools, we actually have something called Correlation Analyzer that can analyze any optionable stock and tell you how well it correlates to the Dow, to the S&P, to the NASDAQ, or to another stock. We can do that with one stock, or we can do that with a portfolio of stocks. It's called Correlation Analyzer, and it sits within tomsoptiontools.com. So that's one way you could do it. Another thing you could do is you could obviously look at put options as a way of looking to profit to the downside. Now, we were talking about a couple of different stocks at the close last Wednesday, and I said, in your homework assignment, I said, take a look at these and take a look at the options trades and see what's out there that's available. And I actually went through every single one of them, and some of them we didn't, they all had call option potentials, but some of them were expensive. Some of them didn't look like they could move far enough to actually make the kind of money we would look for. So I said we were going to fix that this week. And that's what I want to do with you right now. So what I want to do starting right now is talk a little more about the way of fixing, how to take a trade that you're bullish on, but if you buy a call option, maybe it's too expensive compared to where you expect that stock to go. What can you do to fix that if you really want to get into that stock? And so ExxonMobil, I think we found a really good position on it, but we also looked at Schlumberger. If you remember, Schlumberger we were looking at as well. We were looking at EOG Resources. That was at the end of last week. And then, of course, we finished off our homework assignment or our case studies looking at HollyFrontier. Now, all of these charts are in the Oil and Energy Opportunities Report that all of you got by email last week. All right. I also made it available on the live broadcast last week, so you could have downloaded it that way. But don't worry, because if you didn't download it, you have it. It's in the email that was sent to you last week. And if you did not get that email, or you want that that report, then email us. And Jay, if you could just put it in the email address into the chat box there, support@tomgentile.com.
You got it.
So pop that in there. That'll be great.
One gentleman, Tom, when you get to options and such, wants to have you expand a little bit more or talk a little bit more about the implied volatility that you assess when pricing and determining which options you want to do. So
yeah, so implied volatility is very important if you are a call trader only, or a put trader only, or a straddle trader only. If the more you're buying or selling time, the more important it is to look at implied volatility, because you want to look at that and try to get a determination of, based on a historical range, whether or not that stock is cheap or expensive. All right. We're going to discuss a certain stock that has a high implied volatility. It has extremely high options premium, and why trading spreads makes more sense on it. But we're going to get into that topic here in just a few minutes. So what I want to talk about with all of you tonight is two things. Number one, trading spreads. And I've got 3 or 4 case studies that I'm going to show you right off the oil markets. And then we're going to talk about Darknet. And we're also going to look at least one stock that came up on the Darknet buy signal today that I would only trade a spread with. And you'll see it, you'll know it. We'll get into it for sure. So trading spreads. Okay, so I assume that a lot of you on here already know this information. Some of you may not, but the majority of you that are Option X students, you already know this. So I'm giving you a refresher on this. All right, so what are spread options and why do we trade them? Bull call spreads. Now, a bull call spread means that we're bullish and we're using calls, and we're going to spread the difference between where we're buying and where we're selling. So it involves trading more than one option simultaneously. And we're going to trade more. We're going to be buying calls, or we're going to be selling calls at the same time. It lowers your cost, it lowers your risk, and it lowers the day-to-day fluctuation, which I believe equals lower stress. So if you're looking at, for example, where we buy the lower strike call, let's say we're looking at this fictitious trade in XYZ. If you're buying a lower strike call, it's going to be more expensive. If you're selling a higher strike call, it's going to be cheaper, right? Because again, the farther up the calls go, the cheaper they are anyway. But if we put a combination trade in where we're paying 10 for one call and we're selling call for 5, we are getting this for the spread difference, or we call it debit. So for instance, we'd be looking at buying the XYZ 100, 120 call spread and paying 5. If we paid 10 for the 100 call, but we took in 5 for the 120, now we have a debit of 5 points, right? Now, a risk graph, and again, for those of you that need a refresher, there's 2 ways we can look at this. We have what's called classic and we have what's called modern risk graphs. I actually look at them both ways. I like to teach in the classic version, and I like to trade in the modern version. So teaching in the classic version is, any of you that still have paperback books on this subject, you kind of know what I'm looking at here. On a bullish spread, the bullish side, the profitable side, is to the right, and the loss side is to the left. So imagine the stock price going from left to right. And as it goes from 100 to 105 to 120, you go up in value in profits. 3 things you need to see here. The right to buy and the obligation to sell are built into the spread by expiration. You have the right to buy XYZ at 100, but you are obligated to deliver XYZ at 120. So if XYZ goes to 130, 140, 150, I get this all the time. Someone says, I just got assigned on my 120 calls. What do I do? And my answer is, and if you know this, you know what my answer is. It's you jump up and down, because you just put yourself in a position where you have maximum profit. Because if you got assigned short stock at 120, you simply go in and you exercise the right to buy at 100. That means you bought it at 100 and you were forced out of it at 120. You got the full 20 points minus what you paid for the spread. So if we paid $5 for this spread and all of a sudden we're up here and we sold it for 20, what's 20 minus 5? 15. $1,500 per spread, right? The other thing I want to mention to you is the 3 points on the graph. At 100 or below by expiration, you cannot lose any more than you pay for the entire spread. The break even in expiration is going to be what you paid for the spread, in this case 5, Add that to the buy side. So 100 plus 5 is 105. That's your break even on the trade at expiration. 120 or above is the maximum profit for the trade at expiration. Now, let's talk about what happens when you cycle through this losing and winning area. Now, we're going to take 3 traders. We've got the trader who buys a stock, trader A. We got trader B who buys a call. We got trader C who actually buys the spread. So the risk for trader A would be $10,000 if they bought 100 shares of stock at $100. Now, let's talk about the reward. Let's say it goes from, again, stock goes from 100 to 120. Trader A does well. They make a 20% return. Trader B, who's the call trader, if they buy the 100 call for 10, it cost them 1,000. That was their risk as well. Risk is 1,000. Reward at 120 would be a minimum of $1,000 or a minimum of 100% return. Trader C. Trader C is the spread trader who was able to put the trade down to $5. Now, that's a $500 cost and risk. Now, the reason Trader C makes so much more money is because at 120, remember, Trader C made 20 points. Look, they all made 20 points. Trader A made 20 points on the stock. Trader B made 20 points on the call. Trader C
Tom,
made 20 points on the spread.
Out.
The difference spent 10 grand. Okay. So
repeat that last.
This is all about where the stock. Yes, this is where all about where the stock goes from 100 to 120. Trader A spent $100 to make 20 points. Trader B spent 10 to make 20. Trader C spent 5 to make 20. Did you get that, Jay?
Yes, sir.
Okay. Jay, you know what? You and I are going to have a conversation for the rest of the afternoon / evening. All right. So now let's talk about trader. What happens if the stock goes from 100 to 50? Is everyone going to lose money, Jay?
No.
Yes. If the stock goes to 50, everyone on this page loses money. But it's how much they lose. Because trader A loses half of his account. It loses half the trade. Loses $5,000 because if a $100 stock goes to 50, you paid 100 for it, you have a $5,000 loss.
No, I'm sorry, Tom. I was unmuted.
Yeah. So, okay. So you got it now. So trader B, though, only loses 1,000 on the call. Trader C only loses 500 on the spread. But I look at this as a silver lining. I would rather lose 500 than 1,000 or $5,000 on a position. I mean, it makes sense, doesn't it? I would think it does. So, Jay,
yes,
are we ready for put spreads?
Yes. And I'm kind of,
right.
I'm doing emails, I'm doing Q&A, and then I want to make sure I'm present to your conversation here, brother. I apologize.
Yeah. I just want to make sure that everyone hears me. So if I get cut off, just let me know where I get cut off.
You got it.
I'm happy to repeat that then. All right. So put spreads are just like call spreads, everyone, except they're used for bearish opportunities when put options are expensive. Honestly, put options typically get expensive after the market drops. And I know that sounds like a cliche because puts go higher, but the volatility usually goes higher too. Right. So to put on a put spread, you're buying the higher strike and selling the lower strike put. Because remember, the higher strike put, you are exercising the right to sell, and the lower strike put, you're being assigned on the buy side. So again, sell high, buy low. That's what a put spread is. Now, to choose the perfect trade, to choose that perfect trade, that can be subjective. I'll try to dial it down into a simple step-by-step formula for everyone. Jay, were you going to say something?
I was just iterating that came in loud and clear. And the question is, what's your opinion of in the money spreads where both options are in the money when you initiate the trade?
Okay, that's a great question. So I want you to think about a timeline, folks. The shorter time you have to expiration, the more you want that quality option on the buy side. I kind of think of it this way, especially if it's high volatility. If you got a week to expiration, I love the in the money spreads. If you have a month to expiration, I like the at the money spreads. And if you're farther out than a month, I like the out of the money spreads based on where you see the stock going. I mentioned this last week. Jay, let me know if I'm wrong. But remember last week I was talking about when I went into the mall, if I go into the mall with my wife,
yeah,
all right, I only go one of two places typically, and that's Apple and Tesla.
Yeah.
And I look at the board, the little directory board. Where am I now and where am I going? I do that with my trading too. So where's the stock now? Where's my projection? And I build my option position around those two things, right? Because that's going to take you from what 90% of option traders do. That puts you in the top 10% right there. If you come up with a logical reason or a pattern of a stock doing the same thing over and over again, like our oil pattern. Our oil pattern typically, on average, does about 15% between mid-February and mid-July, right? Oil will move up 10 to 15%. And you know, the question I get is, well, is it going to be 10 or is it going to be 15? And to me, it depends on what it did during the time when it wasn't in the bull pattern. We saw oil drop almost 50%, during the October to December timeframe. So I think it's going to go up 15% between right now and mid-July based on the move that it did prior. So I'm basing that on historical probability, back testing, and going from there. So it's what I like to call objective trading. Here were the four stocks that we were talking about. We talked about Exxon last week. We talked about Schlumberger. We talked about EOG Resources, and we talked about HollyFrontier. And one of these, Exxon, had a good call potential when we were looking at the calls. The other ones, they were a little bit higher priced. So I said I was going to talk about those next week, and this is what we're going to do. We're going to look at bull call spreads on these going out during the oil cycle. All right. So that means that the oil cycle ends around July. So either I'm going to look at the June, July, August expirations. That's the area I want to be closest to. If I could hit the sweet spot in July, that'd be great. But if not, if I have to come forward a month, that's fine. If I have to go back a month, that's fine. Let me show you some case studies. Exxon. So last week we talked about an Exxon spread using the 75 calls for $3. Well, guess what? Exxon's actually moved up a little since then. And now I'm looking at where the stock is right now, which is $76.40. So what we're looking at is an out-of-the-money call spread. Out of the money, not by much. Buying the July 77 calls, those are trading for about 3. Selling the July 82.5 calls for 116. So we're able, if we can get back at least a third of what we're paying for. So if I can get a third of that back on the sell side, then I like that trade. All right, a third of the cost. So if it's going to cost me 3 to buy the call, I want to at least, if the spread is $2 or less, then I like it. All right, it's 2/3 of 3. So that's what I want to do. I want to be able to at least pull back. In this case, I'm pulling back on the sell side a little more than a third. So buying the July 19, and we call this the 77.5, 82.5 bull call spread. It looks like this on a risk graph. The risk graph shows me a couple of things. How much can I lose? Right, my maximum loss. It also shows me where we are as we go from 77.5 to 82.5, and then where I max out at above this. This is at expiration. This trade has 155 days to expiration right now. I'm not worried about a correction next week. I'm not worried about a correction in the next month. All right. If I really thought the oil market was going to get completely slammed and that the pattern was not going to work, then I wouldn't even be talking about this. But, we're looking at a pattern that happens over and over and over again. And although there are no guarantees going forward, let me make that perfectly clear. This is how I like to set up a trade where I have a high historical probability with some low risk. This is an example of putting this into a broker's platform. This was the trade cost at 3:31 p.m. today. We were at 76.36, and you can look at like the 77.50, 82.50, July 19th. We're looking at that. And remember, this was just over $3 on the mid, just about $1.14 on the offer. So this right down the middle is 186. I actually like this up to $2. So that's a potential case study I want to tell you about. And again, I'll say this. I'll probably say this a few times. Don't take my word for any of this, guys. All right. you know, it's kind of hard. You might be confused right now saying, well, what is he saying? Don't take his word for it. I mean, do your own homework. Look at the historical probabilities yourself. Look at the option trades and find something that works for you, you know, and own it. All right. Own the pattern, own the spread. Because if you can do that, you'll feel more confident about trading this on yourself, you know, on your own. So let's talk about Schlumberger. Jay, are we good on Exxon, on the Exxon spread? Pretty self-explanatory,
Yes,
I would think.
Yep.
Okay. Guys, do you know the coffee in New Zealand is absolutely fantastic? I mean, you know, and it's not the coffee. I found out it's actually the milk, because this is a big dairy exporting, you know, it's their biggest export is dairy. I found out, you know, I'm drinking the coffee. I'm like, why is the coffee so good here? The lattes, the cappuccinos, it's the milk. The coffee's great, but the milk really just puts it over the edge. Fantastic. Okay. Schlumberger, SLB call spread. All right. So the SLB call spread I looked at, the closest month to July was August. So I looked at this one, and the first thing I thought was, Schlumberger, if we look at it, it's only a $3 call, but if it's only going to go up 50 or 5 points, we think, within the next, between now and July, then we were looking at buying a 45, and if it got to 50, the intrinsic value would mean that $3.15 option would only be worth about $5. So it didn't have the best reward to risk ratio. But by doing the 5-point call spread, buying the August 45 calls and selling the August 50s, you can see here, this can be done for a lot less than 3. It actually can be done for less than 2. Again, risk graph, you can see here, Schlumberger has made that big drop down. Remember, I told you oil got hammered in the month of between October and December, but it's come back quite a bit. And so in order for this one to work out, it's actually got to come back up above, you know, right there around 50. But you've got your risk here, which is less than 200. You've got your reward, which is a little bit better than 300. That's over 150% reward to risk ratio. That's what we look for. And the fact that you can do this for less than $200 as of 3:32 p.m., right? That's what that's showing. And again, I'm looking at the August 16th, 45.50 call spread. Right now, the mid price is $1.82. At the close, it was $175 or $189. Again, $2, you know, on the loose end. But if you really felt like we were going to see a little bit of a correction, you might want to sit yourself like somewhere right down the middle. Again, all of this is up to you. Okay, I am the educator, right? You are the one that's going to take this and say, do I like this energy opportunity? Do I like the call spread? Is there something else out there? Maybe you find something I'm not even talking about tonight, right? But that's the important thing, is that we haven't, I'm looking at an opportunity in energy and oil, and I'm showing you a couple of case studies that I found and that are on my radar. Okay, next one, EOG call spread. So the EOG call spread I looked at was the stock's trading at $97.22 as we got close to the close. And so I'm looking at, all right, out of the money, because this one's a little more expensive. Absolutely, if you're kind of that person that says, I'm not going to pay more than $5 for a trade, you wouldn't have done the 100 call. In fact, we talked about that last week. We said buying the call option is a bit expensive. So what we could look at is the 100 110. And the 100 110 actually drops that price down almost in half. So instead of paying $6.83 to $7, you know, we're at that around that almost half price area. Let's take a look at the risk graph there. Oh, before I go on, I see something here that I can show everybody. I'm sure somebody's going to be asking about these colors. So these colors represent some important points on the option chain. Right. First, the color in blue you see here happens to be the IV that is the lowest of the series. All right. Now it's not that much lower, but it just points that out to me. And typically what I find is out of the money calls on most stocks, as you go further out of the money, they drop in terms of implied vol. On the put side, it's completely opposite. The out of the money puts, as you go farther and farther out of the money, the implied volatility actually goes higher. So those make even greater selling opportunities.
Hey, Tom?
If I were, yes, sir.
Oh, I'm sorry. When you're done, I thought you were done with the colors and such. Just when you get to it, there's a guy asking Steve who wants to know what you mean by down the middle in case of a correction.
Okay. Well, let me back up and then I'll finish the colors. When I say down the middle, I mean the difference between the bid and the offer. You have to decide for yourself what you want to pay for any option trade or option spread. Over here, if you're paying this, at or above this price, you're just getting in at that time. If you're paying in the middle, you're trying to get in between the bid and the offer. And of course, down here, if you're trying to buy it for $1.75, you're probably not going to get filled right away. Right? I'll ask and answer another question. When's it best to worry about where you're paying for an option? Here's the thing. The farther out you're going in time, the less important it is, because you're looking at something that's longer term. It has a better risk to reward ratio. If you're doing weekly options, or you're doing something that's short term, like less than a month, then you want to be trying to get a better price, right? And so that's how I look at it. The more you trade, the more you want to be picky about what you're paying for something. The less you trade, or if you're using longer term options, the less picky you have to be.
And then now, this is a broker specific question there. That DR on your quote for the ask there, can you comment on what that is?
That means debit. That's a debit, which means I'm paying for that spread, where a CR would mean a credit. And so we're going to talk about credit spreads on week 4. So I'll leave that until then. Now, the rest of the colors go like this. So the blue color is the implied volatility low. If there was a red in the box, it'd be high. Over here, this yellow tells me that this particular option has the lowest percent to double. Right? But when I spread these, I'm actually lowering my percentage to double even more. This green box represents the highest volume for that day. And then the open interest is going to be in an orange box. That represents the highest open interest that's out there at that time. Again, let me stress this one thought. I don't really care about volume and open interest in most option trades, especially one that goes out 5 months. I care about the bid and the ask, right? I don't want to see the bid and the ask that's 50% wide. I want to see a bid and an offer that's relatively in that, that range, where if you take a look at, for instance, take a look at the EOG, 665 by 7. So there's a 35-cent bid offer there, right? 35% of what? Well, if I look at that, or 35 cents of what? 35 cents of a 100 call, that's not that much, right? But you got to also think, if you're thinking of 35 cents of, let's call it 7, that is a 5% difference between the bid and the offer. And that's acceptable to me too. Right? We get over like a 10% difference between the bid and the call, and I start looking at other opportunities. So that's important to know as well. All right, so let's move on. This is the risk graph for EOG. No difference. You've got your bottom end, your maximum risk that you could lose. You've got up the curve as we go from the buy strike to the sell strike, and then the maximum amount of profit. This is also a 155-day trade. Our call to action on here, if you want to call it that, is that when you actually go to, when you get to the point you're putting this into your broker's platform, you're committing. You're deciding that you're no longer an analyst. You're actually going out there and taking a position. And so, for an example here, this EOG, it did have a little bit wider spread. Therefore, maybe I wanted to, at 4 or better might be nice. Maybe even at 375, get in there, because it is 325 by 405. That's an 80-cent difference between the bid and the offer, and so that puts it up there quite a bit. But you can squeeze that in. There's been many times where I've gone right down the middle, and a couple minutes later I got filled, or right down the middle and then I got filled immediately, or somewhere in between. I always like to use the word that I'm happy to pay a little bit more to get into a trade, but I don't want to put the guy who's the market maker, I don't want to put his kids through college in the process. So use your own best judgment of what you're willing to pay to get into and get out of a trade. I also mentioned this. It's a lot easier to be picky getting into a trade than it is when it's time to get out. Jay, would you agree with that comment?
Yes, sir.
Because when you're getting out, you want out. Especially if the trade's going against you, you want out. But even if the trade's going in your favor and you're running out of time, you've got to be a little bit more decisive. You got to be willing to maybe let a little bit more go to get closure on the trade. HSC.
Yeah, it speaks out loud when you place a limit on an exit order and you see that you still have it and it's dropping, and you're probably thinking, like, where's my exit door?
Exactly.
Yeah, not fun.
HFC, $57.17. The 60-65 call spread puts it within that kind of 15% move higher. And you can see it was $3.40 to buy the 60 call, but you can do the spread for much less. Here's the risk graph, less than 200, the reward all the way up to above 300. This one has 127 days to expiration because when we looked at this, we're talking about using the June options. So Holly Frontier buying the June 21st 60 calls, selling the June 21st 65 calls. This was 160 by 190. That's a much better spread, only 30 cents. But again, showing you how you can go down the middle. Maybe you say, you know what, because it's closer together, maybe I might have a better chance of getting it filled in the middle. Put it in as 175. And it's just different examples I want to show you of how I treat each case study. All right.
Awesome. Hey, Tom, real quick. Yeah, great timing. Great timing. We've had a handful of questions coming in that are all very similar in the sense of what you do with these trades when it comes to an earnings coming up and or dividend.
Okay. Both. I'm not worried about when you're dealing with 5-month options. When you're dealing with an option that closes 30 days or less, then it's more important. If 30 days or less, you got a lot higher gamma on your trade. And if let's talk about earnings for a second. My question to all of you out there that asked this question is, what's your probability that the earnings are going to push the stock higher versus lower? Do you know that? Because if you don't, guess what? We have that information in Tom's option tools. We have an earnings. We have what's called earnings effects, where we can go back and we can look at earnings stocks in time and see how they performed during earnings the last 4, 5, even 10 earnings cycles ago, where you can look and see what might make the most sense for you, whether you want to stay in that trade or get out. If it's very risky, sometimes it goes up, sometimes it goes down. Maybe the best thing to do is get out of the spread prior to earnings, or maybe not take that trade at all. If it's dividends, now this one can get a little tricky too, because what if you're in between on a debit spread? If you're on the bull call side, you not have to worry about it so much because you own the right to buy the stock. And if it's out of the money, no one's in the world's going to exercise that stock or assign that stock to you to try to take a dividend, because they're probably not going to make as much as you could afford to make by letting them do that. However, if this is a bear put spread, if you're bearish on the trade, then you do got to pay attention to it, simply because the only time I would sit through a bear put spread trade during dividend is if it's in the money and it's making a lot of money. And by then I'm probably out of it already, because my exit strategy is very simple. I like to get out of half of the trade if it doubles in value. Take half your trade off the table if you're trading more than one contract. If you double it in value, it just makes sense, right? Then hold the rest through your target zone. But yeah, dividend and earnings you do need to pay attention to. Earnings you pay attention to on both sides, whether you're bullish or bearish. And if you just don't know, just get out before the earnings. On the dividend side, if you're buying spreads, it's good for you if you're bullish. It's bad for you if you're bearish. That's all I want to put out there for you. All right. Any other questions, Jay?
I would say we're good to go.
Okay. Well, we're going to spend the last 15 minutes or so talking about our new opportunity I want to share with you tonight, which is Darknet. So we're going to spot the opportunity, create the low risk trade, plan, execute, and manage. And that's going to be using Darknet's contrarian strategy, and we're going to just look at calls, puts, and spreads. So this is actually really simple. Darknet was designed by my programmers. Gosh, I want to say probably about 9 years now in the making. And so if you look at a Darknet trade, they are similar to Elliott Wave. All right. So what is Darknet? Well, it's similar to Elliott Wave because it's contrarian. We use channels. Now, Elliott Wave uses actual wave counts, and the wave counts are based on the Fibonacci ratio. So think of Elliott Wave as if you're big in Fibonacci. Fibonacci ratios will show you extensions and contractions, and they do it in percentage formats. 125% for extension, for instance, 61.8% for a contraction, and that's what creates the Elliott Wave channels. What we do is we actually look at absolute channels, and we put a standard deviation around highs and low points, and we create what we call our own channels. Now, what separates Darknet is that our signals are steadfast. That means when they are in there, they never change. If you've ever used Elliott wave in the past, sometimes the wave counts change because you get a new high or a new low. Ours stay the same, right? The other thing too is that when we're using channels, I don't want you to think, oh, I can draw channels on the board and do the same thing. Yeah, you can. But here's the thing. We're using a combination of 3 different channels, long, short, and intermediate, and they're overlapping on top of each other. So when we see overlap, where they stack together, then that's where we're going in and looking at buying opportunities. And Darknet is a buy strategy only. We have looked and back tested for years on the buy and the sell side, and we found that contrarian bullish signals are much better than bearish. Now, that's going to bring a question up, Jay, and I'm going to go ahead and ask it and answer it. What do you do when the market's going down?
Right.
Here is the answer. The answer is this. Not all stocks go down in a bear market. And we get contrarian signals, contrarian buy signals on things like ultra shorts, which go up when the market goes down. We also get them on stocks that have very low or even negative correlation to the markets. And then we get stocks on a lot of randomness where a stock will not move with the market. So that's how we utilize Darknet during periods of time where the market could be pulling back. So this is an example of a channel collision with Darknet. So we have both a long-term, and you might say, hey, wait a minute, there's no low down here, there's no high up here. Remember, this is based on standard deviations of what's happened in the past, and that's what we create to create these channels. So we're trying to forward project where something might come together. And, you know, in a couple of examples, you might have seen we've got long, intermediate, short. Well, there's an area right up here it never got to. There's an area here we never saw. But over here, we got all 3 of them kind of coming together. And we use a tolerance. So it doesn't have to hit exact. But once we get into a tolerable zone that our computer picks for us, that gives us that buying opportunity. This is one example that I just wanted to share with you. Now, the way that we see them on our screen is we see them like this. Here's a buy signal. This is Coca-Cola, all right? So I'm taking you back to last year. There's a buy signal on Coke, and that was at around 43, below 43.5. Then there was a sell signal, it was just above 44, really a nothing trade. Here's a buy signal at 42, call it 42.5, and a sell signal at 45. That's not bad, especially if you're trading options. And then we got nothing all the way up until this particular date, which was October 24th, right? And the buy signal came in. So I'm showing you buy signals and sell signals and how they appear on our screen. Now, when I go into Darknet, and again, all this is based on these channel collisions that are happening. So today, we have channel collisions that are happening. And what I did here is, this is an example. All right, so we're looking at all the Darknet stocks that came up toward the end of the day. And you can see stuff in here like Canadian Pacific. There's Amazon. Amazon was on the trade today. FXY, which is the Japanese yen. Now, tell me something. Jay, I want you to ask this. I'm going to throw a couple of things at you, all right, and I want you to answer because I'm not looking at the questions and comments right now. I pulled it aside. If I see SPX, which is the S&P 500 index, would you say that correlates very high with the Dow or low with the Dow?
Very high.
Exactly. If I said Amazon, you think that correlates high or low with the NASDAQ?
More towards, the NASDAQ, yes. High, very high.
I threw a curveball at you there. Yeah. So, remember, the S&P, the NASDAQ, and the Dow all have some sort of correlation, but they deviate sometimes. But now let me throw this one at you. How about FXY? Does that correlate positive, negative, or I don't know?
For many, it would probably be an I don't know because I don't even know what that is.
That's the correct answer. Because, again, it has what's called random correlation. So you got a couple of them in here that random correlate. You got a couple in here that correlate very high, right? So I wanted to just kind of throw that out there just for everybody to take a quick look at. Now, what we get is we get signals that are entries, signals to look at. They call them list with Darknet bullish. And then we have the stocks in the list with stops. These are stocks that are now out. When you see green on the screen, green is good. So these were stocks that all said get out today. And you can see really green to a little bit of green. I think that's Lennar over there, and that was one that we were looking at about a month ago. I think we started looking at Lennar, and it's done very well. So below, it'll show me based on how I rank it, whether I'm going to look at calls or I'm going to look at puts, put spreads. That's out of the money. Again, I'm going to talk about those. We're going to talk about those on week 4. But you can look at those, and what it does is it takes a look at based on volatility, which was one of the questions that came up earlier in the hour. Volatility, we like to look at the low side for stocks that are, for call trades, and we want to look at the high side for stocks that are, have the high volatility. And if you look at this IV rank over here, so this is a number that's going to go from 1 to 100, and the lower it is to 1, the cheaper the vol is over the long term, and the higher it is to 100, the more expensive it is. So Jay, is it safe to say that every stock on this list except for one, stock number 9, has better than average lower implied volatility?
Yes.
That's correct. And if I'm looking here, I see this BWX has the lowest, it shows, but it has higher slippage, so I'm not really crazy about that.
Hey, Tom.
FXY. So, yes, Jay?
Another thing that's come up, people have been asking in the Q&A boards is like, open interest, you look at volume and all, and I've been answering what you're showing them now. That slippage is key. The tight bid-ask spread is the key to liquidity over and above open interest and volume. Not that you disregard those, but slippage is even more important. And what you're showing is the lower slippage, the better. That speaks to liquidity better than the others.
Yeah, so we have put in a slippage percentage, all right, which is the option over the stock price, which we feel is a very, very good indication of liquidity, because the bid-ask spread is the best indication of liquidity, far better than volume and far better than open interest. So when I'm looking at this is what I'm looking at. What do I like? I honestly like 0.5 or better. So what I'm going to do is I'm going to look at some case studies. And the way that I set this up is, here's my case studies. Up here, and I didn't show this in that slide before, is that let's look at call option trades that have option slippage that is less than 0.5. Less than 0.5. And guess what? I stripped them all out to where we're only looking at 5 right now. So we have FXY, SPX, Amazon, CP, and EZA. So, we could go through and we could look at all 5 of these, but I'd rather just take 1 or 2 and spend a little bit of time on them. So I think FXY is probably the first one. Now, what I'm going to attempt to do, Jay, and I need your help with this, is I am going to go right into the software. And I don't want to move around too much because, obviously I might lose my voice. But I'm going to try it. We're going to see what happens. So over here, I'm going to pop over, and I'm looking at my Darknet trades right now, and I'm looking exactly what we just looked at just a moment ago. And so what I can do within the software is I can go in and, well, first let's look at the stock symbol, so FXY. So I'm going to click on that. That's going to pop up a chart. Now, the reason I do that is I want to go back in history and see if it's worked in the past. All right, there's a winner. Here's a buy and a rebuy. Now, I didn't mention this, but Darknet actually has, you can go to 3 levels deep. All right, so keep that in mind. If you trade Darknet, you want to trade contrarian style. Contrarian style means that you could get 3 signals in the same direction, which means you got to think about that when you're thinking about what you're risking. A buy at 85 and a buy at 83.5 and a sell at 85.5. So we know that the buy at 85 made a 0.5 point. The rebuy actually ended up making almost 2 points. Then you got a little buy sell right here that worked. You got a buy and a rebuy that came in today. Now, what do I know about this right now? This particular stock doesn't make a lot of money. Would you agree, Jay?
That is correct.
Yeah, but it's because you're trading a currency share that's based off of the Japanese yen. It doesn't move around a whole lot. Don't expect doubles on this one. But that's also why the options are so cheap, because I look down here and I see the March 80. Is that the 86 call? Let me blow that up so you can see it. March 8th, 86 call, 73 cents. All right, now let's look at the second one. Forget the second one. I would rather trade SPY than that. Right, and that's immediately what I'm thinking is that why would I buy SPX, which, I mean, it's great, but it's $77.85. I'd rather go in and risk 1 much, much less than that by using SPY, which is literally the same thing. Then that brings me to Amazon. So let's look at Amazon. Here's Amazon's chart.
Yeah, those
now,
intervals.
Notice every time I click on it.
Whereas online were only 50 cents, Tom. So I mean, Amazon, you're seeing they're like 50 points differential.
$50.
Yeah, right.
These are $50 between the intervals. So buy and sell, $50, buy and sell, $50, buy and sell. This is 50, 50, 50. Let's call it 150. And of course today, and I don't have it on the end there, but today it ended up showing a buying opportunity. So that's $62.68. That's expensive. So what I got to do is I got to look at Amazon. And now keep in mind, this is, and this is a question, I don't know if anybody's asked it yet, because there's so many people on here, I can't simply scroll back and forth and look at them and still teach. But one of the questions you should be asking is, whoa, that's a very expensive stock. How long are we in these trades? They're usually about a month on average. So the suggestion is March 8th, and I'm looking at something. No, if I'm looking at 150 points for a possible target, first I want to do is I want to look at, let's go look at the options. So option chains, AMZN, let's update that. Jay, am I still coming in loud and clear?
You are coming in loud and clear, and everything's transitioning on the screen. Pretty good.
Good.
Real fast to where you're talking, so everything
So
looks
this
good.
is the March 8th. The March 8 options. 22 days to expiration. I actually think I like the 15s better. You know what? I'm going to put both of them on the screen. I want to show you something here. This is where I think I know better than the computer. Let's find out what.
Okay, now you just tweaked out there. You just.
I'm right. March 8 options. We're just going to look at the money. Okay, March 8 options. Okay. We're just going to look at the monies. So the closest at the money is we'll call it the 1622 halves. 41.25 by 42.65. So that's going to be $1.40. Is that right, Jay? $1.40 between 41.25 and 42.65.
That's what we see. Yep.
Okay, now let's go look at the money for week 3. I might be wrong on this one. Is it 49.35 by 50.85? That's that's the 1620s. Still though, 46 by 48. That's almost $2. 46. No, $1.35.
Yeah.
That is better. $1.40 is still $1.40. Okay, so
$1.40.
Let me just make this point, and you have to look at these yourself. But in almost every circumstance that I ever looked at, and there are exceptions, the week 3 options are going to be the most liquid of all your option strikes. Week 3 options going out 30 days. All right.
We just lost you.
So we'll stick with the March 8th options because they're actually stick with the March 8 options because it's a tie in between liquidity. Got it?
Gotcha.
Got it. Okay. Now, the next question is, well, how far is Amazon going to go if we got a darknet buy? Remember, we saw some $50 moves and we saw some 150 moves. So why don't we take it and stick it right down the middle and call it 100 points? So what I would look at is perhaps, what's 100 points from 1622? 1722. So maybe what we do is we look at an option 1720s and we sell that. Remember, where are we going? And then let's look at maybe buying the 1700s, something closer. Now with Amazon, the way it moves around, you can go out of the money because the expectation is this thing moves around a lot in a short amount of time. The big thing we want to do here, though, is we want to get this trade down to an acceptable level. Let's see if we
repeat what you
did just that.
Repeat that last comment there, Tom.
I said we want to get the trade down to an acceptable level, a low risk. And I said, let's just see if we did that. And we did. We took a trade that had a $13 call option in it, and we were able to bring the spread down to $3.85 or $385. You see that, Jay?
Yes.
So what we see here is we see the cost, we see the maximum potential return is over 400%. We see our risk graph, and it's just a matter of now applying that and getting that into the trade. All right, so that's Darknet. And let me just wrap up by going back to the actual Darknet trade. So we had Darknet trades that were showing on FXY, SPX, Amazon, CP, and EZA. Now, again, what do is I verify the position first, and I look at how it did in its past with Darknet signals. I then try to get the average of where it moved in that chart, so I can get a projection of where I think it's going to move going forward. And then I place my option trades around that. Right? I'm looking at FXY. I don't need to spread that. That's a 73-cent trade. If I'm looking at EZA, I don't need to spread that. So that's $2.80. But these other three in the middle, when it exceeds the cost of $5, I look at it and say, can I spread this, and can I get a risk to reward ratio that's better than 100%? All right, Jay?
Gotcha.
Awesome. All right, so at that point, we're going to come back to our slides. I was on our slides. And at this point, are there any questions, Jay, that you see that, I know there's a ton of them, but anything you see that's been popping up?
One that's more consistent over others is, can you do puts? What about doing puts on the Darknet signals? And I think you iterated it, but we might want to reiterate it.
Okay.
This is the bullish stance.
So I'm going to answer it two ways. Number one, it is a bullish strategy only. But if the person's asking can I trade puts with it? Yes, I can sell puts. Right, but I may not want to open end sell a put option on something like an Amazon, because all of a sudden now you're opening yourself up to a lot of risk. But what we could do is put credit spreads. Now, I'm going to save that conversation for 2 weeks from tonight. All right, we will circle back around and we will spend a lot of time on trading credit spreads, okay? Because that's actually our bonus, one of our bonus sessions. We're going to do 2 bonus sessions. I've never done this before since we started teaching online for Optionetics, but we're going to have a bonus session in 2 weeks from tonight on credit spreads, and we'll get back to that kind of that scenario. So I'm not going to get away from the Amazon trade. We'll go back to it and look at it again in 2 weeks. But we're also going to be doing a lot with credit spreads then. So at that point, I want to stop. Yes, you can, but on the bullish side, you're going to need to use something called bull put spreads. Anything else, Jay?
You do have a Darknet spreads button in there. Somebody was asking about that, and we do have that.
We have Darknet spreads button in there. Obviously, I would love for you to know something about spreads before you start using that. I'm sitting here in New Zealand, guys, and I've got appliances I don't even know how to use. And I had the builder in earlier today, and he was showing, we were trying to figure out how to use the microwave. And so and I'm sure it's my fault because I don't know some of these things because they're a little different. It turned out there was another little pop switch on the side, which is like a breaker to turn these things on, because I couldn't even get them to work. And I realized after someone showed me, oh yeah, you got a little internal breaker that sits on the side. But that's just one thing. It's neat little curiosity things. But once you know how to use put spreads, then buttons and scans become a whole lot easier.
Gotcha. Now you referenced a correlation analyzer tool, Tom, earlier, and I wanted to interject there, but I was too late. We do have a video on that, and there is a video library in there that you can go ahead and look up that tool if you want to find out more information on that. And then, did you want to do anything on the energy report there, Tom? I mean, most of these guys already got it from last week, but we have on tomgentile.com, we have the report. If they want to put any friends or family into the report, they can have them go fill out the information requested report there.
We posted it. Yeah, you're right. We posted it at www.tomgentile.com. That's where I put a lot of free reports and stuff. You're welcome to go get it over there and look and see if anybody else wants it. Also, I want to mention, follow the Darknet case studies we've discussed tonight. We had 5 of them there. We just talked about one very briefly. and that was Amazon, and we'll follow up with that again. We'll follow that up next week. So I want to follow up with that next week. I want to follow up. We'll check in with my brother-in-law and see how he's doing. We'll check. I want you to check the videos out if you have any questions on tomsoptiontools.com, or you can go to YouTube, our YouTube channel, which is youtube.com/Tom's Trading Room. All right. Those case studies are we'll be discussing, and you can look at different ways of scanning. If you're new to us, there's a free trial that's available. You can go to our 7-day free trial. It opens up everything that we talked about in the last 2 weeks, plus what I'm going to be talking about next week, which, by the way, is the review of week 1. We'll do a review of week 2. We're also going to talk about trading with a money calendar. So for those of you that are here for the first time, what is a money calendar? It's actually a patent pending tool that I created several years ago that we're in the process of getting a utility patent for. But it's really a cool seasonality piece. It's not some, I don't like to call it a little tool. It is a major thing. Oh, I got something else I want to share with the group today too. We have apps that are now available for both Darknet and for the money calendar for our users, right? And I'm going to tell you how you can get those next week. But they're available on both the iPhone, and they're also available on Android devices. So you can find them in the App Store for Apple, and you can find them in the Play Store. I guess it's the Play Store for Google. And then you download those. And for those of you that are questioning that, you're all excited. I mean, they're very cool. I'm going to be showing them next week, and I'm going to be showing you how to get those. All right, so we'll talk about that next week along with the money calendar. Jay.
Lots of excited people coming through the Q&A boards on that one, Tom.
Cool. Oh, man, I'm telling you, these apps are so cool. Really cool. Next week, I'm actually going to be on screen. I'm actually going to show them to you on my phone. So it's not going to be something that's going to be, I mean, I'll snap them and put some stuff on a presentation, but I'm actually going to work through the phone with you guys so you can see how they work. They're really cool. I mean, we've been hard at work over the last several months perfecting these things, alpha testing them, beta testing them, and we're ready. So we're going to show you these things. You guys will be the I mean, our partners have already seen some of this, but you guys, we're showing them for the first time to not even to the public, just to the group.
To our Optionetics folks. Yeah.
Absolutely. So look forward to sharing that with you guys. So anyway, thank you very much, guys. It is still warm and sunny outside. There's not a cloud in the sky here. In fact, it's actually a little bit on the hot side down here in New Zealand. I'm not going to be here for very long. I will be back. I'm only here for a few more days, and then we're jetting out of here and head back, and I will be back in the saddle before trading starts next week. So anyway, guys, thank you all for being with me here. I hope this came in loud and clear. We'll get the recording up to you. It might take a few hours because of the trip that recording is going to have to take from New Zealand back to America, back to you. But I'll have it to you as soon as possible. And then I'll have the information that we talked about tonight with Darknet and with spreads, so that you can have that information. Those slides are available to you. All right. Thanks again. Any questions, guys, feel free. If we didn't answer a question for you tonight, or if you have any questions on anything we've talked about so far, support@tomgentile.com. All right. Have a great afternoon, evening, or morning, wherever you are, and I'll see you next week. All right. Bye now. See you, Jay.
See you, buddy.